trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. And welcome back to all of our Market Rebels, and Happy New Year. Looking to start off a great 2024. Stu, great having you here. It looks like our market's a little bit of a downturn. I think we were basically flat. Maybe, what was it? I didn't see the close. 0.3 or so down on the SPY.
0.3 down. Dow was up 0.1, and the Qs are down 0.5. Basically flat. Pretty flat.
Pretty flat. But hopefully we're going to find some support here. But what I thought we would do here today is to take a different look at options. One of the things we like to do here at Market Rebellion is to show different perspectives. That's why we're real big on synthetics and understanding the mechanics of options. Because when you truly understand what you're looking at or what you're not looking at, you can make better decisions. It's very easy to get lured into misperceptions with options and in the stock market. So Stu, today, let's do something a little different here. Now, we talked briefly about this in Q&A for all the people in our Q&A, but we're going to do a more in-depth discussion on it. So here's our question for today.
Okay.
So for anybody who's new, we always like to kick it off with what we call Chalk Talk in honor of our coach's corner here. And it's just a little thought question, and we come back at the end and give you the answer. So the question for today is, which options carry the most information? We're going to narrow it down to you into three classifications, what we usually call moneyness: in the money, at the money, or out of the money. Now, normally people go, what do you mean carry the most information? Well, I said we're going to show you a different perspective.
Keep in mind that information, the quality of information needs to be able to help you make a decision, alter a decision, come up with a decision.
Yep.
If that information can't provide any of those things, it doesn't really do anything for you.
Doesn't do anything. We're going to actually have a slide about that. So yeah, very good point. So let's talk about which options carry the most information. Now, why do we want to do this? Well, again, once you understand which options carry the most information, it will help you to make decisions about which ones to buy, which ones to sell, and just also have a better idea of where the pricing is coming from. So let's start off with a couple of building blocks here, Stu.
Yeah.
Let's talk about certainty.
Certainty. Certainty. Is there any certainty in the markets, Bill?
Very little. Very, very little. Few things, but not much. I was just talking about this. This was the point you brought up. The first thing to understand is that information only has value if it can alter a decision.
Really important here. Really important.
This is very, very important. It's really we're going to come back full circle a little bit later. So think of it like, Stu, if I offered to sell you the information, if we're going to flip a coin, and I say for a certain fee, I'll tell you if the previous flip was heads or tails. Well, what's that going to do for you? It offers no help whatsoever.
None.
So it would in no way help you to make a decision.
And consequently, I really wouldn't pay for that information.
And you wouldn't pay for that very reason.
That's right.
So
and it's not because I'm cheap. It's because it doesn't do anything for me.
So here's the first thing is that if something is certain, or at least moving in that direction towards certainty, it carries no information, or at least very, very little. Why? Mm-hmm. Because everybody knows. If something is certain to happen, then why would you pay for information about what's going to happen? You already know.
You already know.
On the flip side, also to remember, so the thing to remember is that 100% certainty has no value.
It's really the same thing as no information. It's just the other side, right, Bill?
We're going to talk about that, yeah. And I know you're a real big believer on always talking about the other side of the trade, and that's an important perspective. So let's take a look at this. 0% certainty would also have no value.
Yeah,
because they are just two sides of the same coin. I could either say it's 100% certain that something will happen, mm-hmm. or a 0% certainty that it won't happen.
Right.
There's just two different ways of really saying the same thing. So just realize for right now, for our little building blocks, if something is 100% certain or very close to that, it's carrying very little information and therefore carries little value. Mm-hmm. If something has 0% certainty or in that direction, it also has very little information contained in it and therefore has very little, or in the extreme case of 0% certainty, has no value. All right, so what does this have to do with options? Well, we're going to get there. Before we do, for anybody who's new, please check us out at marketrebellion.com/get started. There is a ton of bad information out there. I can't even describe to you. Stu, I know you and I talk about this. We email stuff back and forth. Look what I found out, or look what I heard. The stuff that goes out there is beyond ridiculous that people are trying to teach. Yeah, it's incredible.
Yeah.
So just be careful where you get.
Unbelievable.
Yeah. And usually what they want to do is to charge you an arm and a leg for their quote unquote PhD program, like they're going to give you the secrets to making all the money in the world for no risk. Doesn't work that way.
There is a secret sauce out there somewhere, isn't there, Bill?
Very little. The secret sauce, I think we both agree on this, is education.
Yeah.
You have to understand what you're looking at and why these prices are there and how the strategies work. That's really where the money is made. Yep. So anyway, check out marketrebellion.com/get started. Lots of free stuff.
Unless you have some information that maybe somebody else doesn't, then that information has some value.
That's right. That's a whole different story. That's why inside information is so valuable.
Yeah, it's also
so let's take a look at an example here. I'm going to use roulette. I use this a lot for the classes. Now, we're not here to teach roulette. Pretty simple. There's, at least for an American board, there's 38 spaces on the wheel. You can see 1 through 36, red and black. We got these two green guys up here, 0 and 00. Mm-hmm. And the basic strategy is you can either put your chips on a single number. You bet on 3 and it comes up 3, you get paid it would be 35 to 1. You can bet on these columns. You can bet on 4, called a corner bet. You can bet on a row, called a street bet. There's all these different types of bets, but these are really the choices that you get. So the thing that I want you to understand is that if you bet on 0 or 00, it's only, roughly speaking, please don't get out the calculators. I know it's not exactly, but it's roughly speaking 5% of the board. If you bet
the total number of places
of the total 38 numbers up here. Mm-hmm. If you bet in this group, you've got about if you bet on that it's red or black. Not one or the other, but either or. That's 95% of the possibility. Mm-hmm. Now, if you want to bet on red or black, just one or the other, it's going to be about 50%. Again, not exactly, because it's really 18 out of 38, but it's pretty close to 50%.
Close enough for the illustration.
Close enough for the illustration. All right, so I want to just give people this little background here on roulette. So now think about this. Stu, I'm going to tell you that I have a trusty crystal ball. In fact, this is a highly polished Swarovski crystal ball. It is 100% accurate. And I'm going to give you some offers for some information. And you're going to tell me.
I need one.
No, you can't have it. Nobody gets it. So here's the first thing. I'm going to allow you can ask questions. Yeah. And then we're going to come up with a fee of how much that information would be worth. Okay. So going back to roulette,
Yeah.
Would this be a good question to ask? Will it land on red? Again, both meaning red or black. Both of them are included. Would that be a good question to ask the crystal ball?
No, because I already know that it's probably most likely.
Right. We just talked about that.
certainly.
It's about a 95% chance. So it removes very little uncertainty.
So why would I pay money to?
Why would you ask the question to the crystal ball, and why would you offer to pay money for
Yeah.
me to ask it or for you to ask it? You'd say, because I already know. But the
Yeah.
point is we're moving towards certainty.
Mhm.
And so again, it's got very little information contained in that question. All right, let's try another one.
Yeah.
Would you ask the crystal ball, will it land on green?
I think you're tricking me because that's the same question.
Very good. It actually is. It's a 5% chance for this to say yes, which is the same thing as saying it's a 95% chance that we're going to hear no.
Yeah.
So both of those questions have a 95% that we already know. We already know in this case that the answer is most likely no. In the previous question, we know the answer is most likely yes.
And again,
but notice that as
what are you going to pay for that?
right, it's not removing any information. It's not conveying any information.
Mhm.
So notice that we're going very close to 0%. In the previous one, we were getting closer to 100%.
Yeah.
All right, now watch what happens. Something magical happens. What if you picked one of the colors, not counting green, and you said, will it land on red? Would that be a good question to ask?
Yeah, well, I think so because it's now a 50-50 shot, pretty close to 50.
Very good. You're removing a ton of uncertainty.
Yeah. So if you think about it like, all right, which one am I trying to guess? You can also say, which one am I trying to not guess? It's really
exactly different side of the same coin.
Half is left. If you guess the half, then the other half is gone. Either way, you come out with the same answer.
Either way, you've got a lot of information because we've basically eliminated half of the board. So something like that would be a really good question to ask. Right. So hopefully that gives you
thinking about options and deltas and different spaces of options as they watch this.
Yeah.
This is
so
really
the thing to see that right now, hopefully that's a good illustration of the point of if we go towards 100%, not real valuable. If we go towards 0%, not real valuable. But if we go right there in the middle, now we're talking because now we can remove half of the uncertainty. Mm-hmm. And that's big. So let's go back to uncertainty here. Removing uncertainty has value. That's the big thing that we're always trying to hedge in the markets and this volatility. What's the stock going to do tomorrow? I don't know. That's uncertainty. Now, the maximum what do you think the maximum uncertainty is? What level is that? We kind of already talked about it.
Can't be more than 50%.
Would be exactly 50%, right? Because I always laugh about this. It's like the weathermen when they say there's a 50% chance of rain today. I always say, thanks, but no thanks.
Yeah,
that's worthless information.
Yeah.
I could have told you that with a coin flip. If you're worth anything, at least tell me there's a 51% or a 52% or a 49%, but not 50. 50 says, I have no earthly idea. So that's the worst case of uncertainty that you can possibly have. So again, if you can remove 50% of the uncertainty, you're maximizing the amount of valuable information. Pretty cool. Different way of looking at things. We'll show you what this has to do with options in a moment. So graphically, here's what it's going to look like. Let's say this is a graph. Down here we have Zippo information. Up here we've got our maximum. So as we saw, if we have a 0% chance of something happening, that carries no info and therefore has no value. What if it has a 100% chance? Other side of the same coin. It has no info, conveys no information, and therefore has no value. But what if you're right here in the middle? That's the max. That carries the most information. So the kind of the almost like a profit and loss diagram, but a risk graph, so to speak, would look something like this. And the point is that as you move away from 50%, you're getting into less and less information.
Looks like a bell curve.
Kind of does, doesn't it? Not to be confused with one. But the thing to see is that as we go away from 50%, that will be important in a minute. You're conveying less and less information. You're removing less uncertainty, and therefore it doesn't have a lot of value. All right. We'll take our next step here again. Quick reminder for everyone, please check us out, marketrebellion.com/get started. Lots of great videos, articles, lots of things to help you understand the basic points and the finer points of options trading. So, Stu, and I'm sure that most of our viewers out there remember from the Price is Right game show. And there was one of the games on there, I believe it was called the Showcase, and they would show like a trip and a car or a camper and a boat and jet skis, and they'd have all these different packages, and they would have some type of a retail value. Yeah. And they would tell, of course, the contestant didn't know what it was, but they had to guess in something like 30 to 45 seconds. There was a little clock.
The price, yeah.
And they're just banging out these.
Whoever got closer, which is the winner or something like that?
No, they had to get within like $100 or $1,000.
Right.
That was the first level when they got called out of the stands. It was person closest. But the sweepstake or the showcase, they had to get pretty much spot on. So to make it simple, now I know we talked about this before, just so we could go through this quicker. I presented this to you earlier, so I made a slide of your guesses here. But just to make it simple, let's say we have two prizes. You're shown a trip to Tahiti and this fancy sports car. Now, of course, we don't even know what kind of car that is, so it's kind of unfair to Stu, but we still have at least a reasonable guess.
I was looking at the hubcaps, the wheels.
I don't think those are hubcaps. So anyway, let me start off by showing what not to do. In other words, a ridiculously dumb strategy. You don't pick a price, let's say, I don't know, how about 200,000? And the host would tell you if you're over or under, or too high or too low. And if he says too high, you wouldn't go, how about 199,000?
Why not?
That's too high. How about 198.5?
What am I doing here? What am I doing, everyone? If I go down by 500 or 1,000, what am I actually getting rid of?
Right. Nothing. You're removing very little uncertainty, and therefore
all I'm doing is wasting time and wasting.
It's an invaluable guess. Right. So in other words, it's more likely for the price to be in the range not guessed.
Yeah.
So this would be an incredibly bad strategy. And yet every once in a while you'd see somebody do that. They'd be pretty certain it's at a certain price and they just poke around, even though they might be way off in left field.
It's almost counterintuitive to kind of think about,
It is. Exactly.
And I stress this all the time in my coaching sessions. Like, what you can see is obvious. Think about what you can't see.
That's right.
That can bite you. Think about the things that can happen. The things that you're not thinking about are the things that are going to happen. And that's the places where you need to hedge your risk off.
Absolutely. So let's take a look at what to do. Go back to our little bit about information.
Yeah.
Give it your best guess, something where roughly half the values would lie above and half would be below. So you've got roughly a 50-50 chance that you're high or low. Okay. Now, if your answer is too low, double it. You're going to multiply by 2. And if it's too high, you cut it in half. But you're always working in these factors of 2.
Because you're trying to cover the most ground.
And that's exact because you're removing the most uncertainty.
Yeah. Right. You're trying to find a place and you're trying to cover the most ground to find the end
in the shortest time. Correct. So once a high and a low is established, just continue to cut the range in half. So that's the first key, is to get a low and a high. And then each guess establishes a new high or low, but removes the most uncertainty. And again, therefore, they are the most valuable guesses. So now you have to play along with me. Let's say that Stu can't see this, but we have to put it up there so that everybody else can. I just made up a number. Let's say it's 128,400. He's got to get it to the closest 100. He's got to get down to 128.4. Even let's say if it was 128,430 or something. This is the number that he's got to get.
Whatever the number, it doesn't really matter.
So now earlier, I just did this little part with him so I could record the screen so everybody could follow along. Stu, what was your first guess?
200,000.
200,000. And I said too high. What was your next guess?
100,000.
100,000. Now look at this.
Now I just removed half of it. Okay.
You removed half of it.
Yeah, I didn't remove.
So in two guesses, he's already straddled the range. But notice, even if he had guessed 400,000, in three guesses, he would have still hit this target.
I would have been in one guess. I would have been down to the 200 to start out with. It really would have been the same thing except one extra step, and
extra step, and that doesn't cost you a lot of time. That's the benefit of removing it or doubling or cutting things in half. So now what he's going to do is he's going to continue to cut this range in half. We have $100,000 difference. What's your next guess?
$1.50.
$1.50. And I say that is too high. So now he's got bookends again. He knows that 150's on the top, 100's on the bottom. Got a 50,000 difference. He's going to add 25,000 to it. So I said 125 is too low. But notice that now he's only 25. He's narrowing in quickly. Now here you actually did a kind of a cool thing, and I would have done the same thing here. Technically speaking, mathematically, there's a 25,000 difference here. We would really want to cut it into 12.5. The problem is that next time you're going to have to start going into halves, quarters, and eighths, and it can get
halves, just quarters, and
it can get a little tricky to follow. So what you did, what I thought was very cool, you went to 138.
I just rounded it up.
You just rounded up. Okay, so I said 138 is too high. All right, what's your next guess? Notice that we are 13,000 off. So again, we're going to be somewhere around 7,000. And then I think you went to 132.
Yeah, I kind of just rounded, and it's half of the distance. And
half the distance. So now he knows it's between 125 and 132. And now he's within 7. Now he went 125. Yeah, now he went 125, 129. He's within 4,000 and just a handful of guesses. So he's going to go up by 2,000. 127, I say, is too low to 129. Now he's within $2,000,
right,
of a price that he had no idea what it was. He goes to 128 to 129.
Anywhere in here, I could start going by 200s or 500s, and
he could. Now, what most people would do here is let's split it one more time. Let's say 128.5, and rather than having to do these calculations and continue to split, the contestants would just start reeling off 128.1, 128.2, 128.3, 128.4 and get it. But the thing to show is that in 1, 2, 3, 4, 5, 6, 7, 8, 9 guesses, he's within $500. That's incredible. Now, again, even if he had guessed 400,000, would have just been one extra guess.
Yeah, one more.
Or if he had guessed 50,000, would have just been an extra guess.
Yeah.
But that's the power of removing things in at 50% levels. All right.
50. Keep that number in mind, everyone. 50. Think about options. 50. Go ahead.
Yep. So now, what does this have to do with options? Well, I'm glad you asked, because that's ultimately what we're here to talk about. This is about the at-the-money options.
Wanted to talk more about Bob Barker and The Price is Right.
Well, options market, here's one of the things to understand about the options market from a philosophical level. The options market, every minute of the day, every second of the day, is trying to resolve every option strike into two different camps. Will it be in the money at expiration, or will it be out of the money? Out of the money being just same as at the money. It's just as good as out of the money at expiration. So think of it like if you're in Vegas watching a football game, and as the game progresses, what happens to the odds? They change. They're trying to figure out which team is going to win. That is exactly what the options market is trying to do every second of the day. And the way that it does it, which options will be in the money, which will be out. So now, if we have a deep in the money option, what do we know about that, Stu? If you had to guess if it's going to be in the money or out of the money.
I'm going to go within the money because it's already there.
It's already there. And it's deep in the money. Even if the market tanks, let's say for a call, it's still probably going to be in the money.
It's still in the money.
So how much information did that option give him about it being in the money or out of the money?
Yeah. Now, keep in mind, this isn't really about range, everyone. We're not really talking about implied volatilities and prices. And all that. We're just talking about options that are giving you information that are worthless information, or in the money or out of the money. Range is another topic, and we will cover that somewhere else. But that's not what this is.
Right. Now, if we go to deep out of the money, what's your best guess if that's going to be in the money or out of the money at expiration?
Got to go with out of the money, man.
You got to go with out of the money. In other words, these are pretty certain. Yeah. This is exactly like we just saw with the roulette table.
Yeah.
You're pretty sure you wouldn't pay for information to say, hey, Stu, I'll tell you in my crystal ball if this deep in the money option is going to be in the money. You'd say, well, I already know that.
Yeah, I already know it, so I'm not going to really pay anything.
It's got no value. Mm-hmm. Deep out of the money. Hey, Stu, I'll sell this to you if that's going to be in the money or out of the money at expiration. Well, you know what? I kind of already know that.
kind of why out of the money options, far out of the money options are like 15, 20 cents, if anything.
We're going to talk about that. Exactly right. But the at the money options are the most uncertain.
Yeah.
And therefore, they convey the most value, which means, actually,
Shocker.
question for everyone.
Yeah.
Everyone always thinks that the options price is the total premium. You and I see it from a different perspective. We always talk about the extrinsic value.
Yeah.
So that means if you want to talk about the price of the option from a professional trader standpoint, we're not worried about the intrinsic. That's not even interesting. We know it's got to be there.
Trading cash for cash. That's it.
It's just cash for cash, right? Okay, big deal. But the extrinsic value, that's where the action is. All right, so now, keeping this in mind, let's go pull up a quote board. These were the spiders. I think I just shot them yesterday, but they were trading for pretty close to 471. All right, now over here is our extrinsic value column. That's what you and I would call the true price of the option for the right to walk away, not the intrinsic value. That's just cash. So keep an eye on this column. Now here's the 471 strike. The extrinsic value is 338. It's the highest extrinsic value on the board. Why? It conveys the most information. If you buy that put, it is removing half of the uncertainty about what's going to happen. We know that anything below this, you're not going to be exposed to. If you buy a call, you know that you're going to capture anything to the upside. You're not going to be exposed to anything below that. It's removing most of the uncertainty. So what happens as we start going in this direction? We're starting to get closer to 100% certain. Now, we're certainly not there at this strike, but we're moving in that direction. And so what happens to our price? We go 334, 304, 265, 244, 213, $1.93.
And again, let me just emphasize here that Bill is removing the cash portion of this. He's removing the
exactly.
Value. So that has nothing to do with
right. So if you've got the 465 strike and the index is at 470, we know it's got to trade for $5.
You know it.
That's not remotely interesting. We got that. What we want to know is what's the market willing to pay for the uncertainty, and right here, not a lot.
Or another way to say that is for the right to
walk away. Because they already know that they're not going to be walking away from this deal. Somebody's going to be exercising this most likely. So that's what the market's trying to do. Now, we could see a different story tomorrow, but right now, that's the way the market's forming. What happens if we go in this direction?
The deeper you go into money, Bill doesn't have it up here, but the deeper you go in the money, the lower that number is going to be.
Theoretically, you could, now, not all of the short term, this has only had 8 days, but if you could go up to 400 strike, a 350 strike, they would eventually start hitting zero extrinsic value.
Yeah.
Or maybe a couple of pennies for cost to carry.
Yeah, taking out cost to carry, yeah.
Yeah, they're just not going to trade for anything. And that's because we're moving towards certainty. Now, as we go in this direction, what's happening? Remember that earlier one, you said it looked like a bell curve, that chart? I had those arrows as we move away from 50%.
Yeah, man.
That we were going towards either 0 or 100%, and that had no value. Same thing here. We're going 291, 242, 203, $1.61, $1.33. We're getting cheaper here. Why? These don't convey a lot of information because we're moving towards certainty. I could either say I'm 0% certain this will be in the money, or I'm 100% certain that it will be out of the money. Two different sides of the same coin.
Let me just take a sidebar here for a moment and just say, hey, we know it's not 100%, and we know it's not 0%. We all know that.
Moving in that direction.
We're just illustrating with extremes, right? We're moving. Correct. It's moving towards that area,
right? And depending on the volatility and time to expiration, you might need to move to a 600 strike or a 700 strike. It's the same concept. You might need to go down to a $10 strike. It doesn't matter. You're moving towards 100% as you go to lower strike calls, and you're moving towards 0% as you go towards higher strike calls. The opposite would be true for puts.
Puts, yeah. Higher.
So that's why it's kind of an interesting look that to understand why this has the highest value, not the highest total, the premium, the highest extrinsic value is that the at-the-money options convey the most information. They allow you to remove half of the uncertainty. Now, that doesn't mean you have to do it. It does not mean it's the best. But if you understand that, it will help you to make better decisions.
And it's not picking. It's not picking a direction for you.
No,
It's not doing that. It's just taking out half of the equation. If you
taking out half of the equation,
pick a direction.
Yep.
If you do pick a direction. Now you can actually use a call, and I know we're going to get into another topic here, but I'm just going to take 2 seconds to do it. You can actually use a call to speculate to the upside. You can actually use a call to speculate to the downside as well, using the synthetic put with stock and blah, blah, blah. But hey, that's another topic that everybody should know. So sorry.
Absolutely. Yep. Very true. But these are some of the things that we really like to point out, because if you understand what you're looking at, it's easier to make decisions. When Stu and I look at this board, we see a very beautiful symmetry. We can see skews. We can see tilts. What do most people look at? Just a mishmash of random numbers, and they get immediately lost.
Or they look at the price and say, I can do this one. I can do this one. I can do this one.
I can afford $3, or I can afford $2. Let me pick that one.
I can afford, but meantime, they just paid for something that is basically,
guaranteed to be a lose. Right. Just bad ideas. So anyway, we hope that gives you a different perspective of what you're looking at with options, why we start getting lower extrinsic value as you move away from the center, meaning the at the money strike. And that's because those options I call them in the wings at the extremes, convey more certainty. In this case, 100% certain that it will be in the money for the calls. Down here, 0% certain that it'll be in the money, or 100% certain that it'll be out of the money. But in both cases, what's the key word in both of those? Certain. We are moving towards some degree of certainty. And so the market says, you know what? I kind of already know there's going to be in and out of the money. I'm not going to pay a lot for them. But the at the monies are a whole different story. So we hope that gives you a different perspective when you're probably not going to see in other places. And we'll certainly continue to bring those to you throughout the year. And Stu, I think next week we got a special request for RSI.
RSI,
little technical analysis.
RSI, relative strength indicator, and that's going to
index.
Be a presentation as well.
Yep, we got some very good stuff on that. So I'll show you some very cool insights. Again, some different ways of looking at RSI that you're probably not going to see in other places. So we hope to see you then. So the main takeaways, may understand that the deep in the money options are driven more by delta. That's more of a delta play, because it's getting more relatively certain that it will become stock. It's got a high probability.
That's why you might want to buy that deep in the money option if you're
helps you to think about why would you do it.
Be a purchaser of stock using a stock replacement strategy.
Deep out of the money options are driven more by volatility, because they've got a low probability of expiring in the money. That doesn't mean that they're bad tools. We have to understand the right times and reasons for using them. And understanding this whole idea about conveying information will hopefully at least help you to make those decisions.
Yeah.
So Stu, let's go back to our Chalk Talk question and test everybody out there on YouTube. So which options carry the most information? Most people have never heard it worded this way.
How about all of them? No, come on. We've already been through this. The at the monies. They carry
at the monies. Carry the most information.
That's why they're the 50 delta and
there you go, 50 delta.
And that's why for sellers you get paid the most, and that's why for buyers you pay the most. They carry the most information.
They carry the most information. So if you have any friends that say, "How come these at the monies cost so much in extrinsic value?" Tell them because they carry the most information. They're going to look at you like you've got two heads, and you're going to realize that you know more than most people, because that's what we want to do here, is to show you the proper way from a professional trader's perspective of how to look at the options board. So Stu, any closing comments?
I would say, take this presentation here and just kind of think about like what happened here and try and apply it towards a matrix, kind of think about
practice with it.
Practice with it. Why is this option a 70 delta or an 80 delta? And why would I want to use it? Why is this option a 30 delta? And why would I want to use that? And under what circumstances would each of them might be appropriate, and practice with it.
And if it was an 85 delta, why is it now a 60 delta?
Yeah.
What happened? Well, the market has changed its opinion about whether it's going to be in the money or out of the money. Right. Mm-hmm. All good stuff. So we hope that helps. We appreciate you being here, and we will look for you next Thursday. We have another really cool one. Scott's going to join us as well for that one, Stu. And we're going to talk about relative strength index, and we'll see you then.
All right. See ya.